preparing versus planning. And most things in life, they seem to go hand in hand, if not kind of the same concept. However, when it comes to your taxes, it is a very different subject matter when it comes to these two words. I'm Heather Branch. This is Michigan's retirement coach, certified financial planner, Mike Douglas, ready to give us some insight, some intel, some 411. Do the kids say 411 anymore?
They sure don't.
Sad. They sure don't. They don't even know what it is.
No.
But if you are close to retirement or retired and watching this video to learn about tax planning, hey, fix that camera there.
I just kicked it with my foot.
You just fix it. Don't. No. If you're listening to the podcast, be sure to check out our YouTube so you can see the kick that just occurred.
Wow.
I don't even know what happened. It's like
so excited to talk about taxes. I'm just kicking cameras and
slapping microphones and
let's do it.
Come on.
That's right.
Let's talk taxes.
Taxes.
What was I saying? Preparing versus planning is a very different concept. Oh, that's what it was. 411. For those that are close to retirement, you know exactly what I'm talking about. Educate your grandchildren because they need to know. Okay, so it is that time of year, but this time right now we are recording the podcast in the month of March. So tax filing deadline is now just a few weeks away. And for a name that we have come, if you listen to Mike's radio program or in this podcast, we've talked about Ed Slott a lot because he is just, he's become known as this tax guru in the financial industry. He has a lot to say, but it's interesting because he actually started his career preparing other people's income taxes. But now Mr. Slott is talking about the importance of tax planning, preparing versus planning. And here's what he told Morningstar about his early days as a CPA.
Every year they came in, I'd say, oh, you know what you could have done? Oh, you should have done this. Oh, you missed that. I was this bearer of bad news each year. And it hit me that stopped after a few years, that who wants to hear what I could have, would have, should have done? And I realized you can't go back unless you had a time machine. So I realized I was looking backwards, reactive. And that's when everything changed for me. I said, wouldn't it be more valuable if I did tax planning instead of tax preparation? And that opened up the whole world of adding value, tax planning, looking ahead.
You can't go back. You're not Marty McFly.
That's right. You can never go back. So they're saying all dogs go to heaven. Yep.
But obviously the points that he makes are points that you have made before, because for so many Americans, the whole idea around taxes, it really does. It focuses on April 15th and working with the CPA. You are not a CPA. You are a CFP. Mm-hmm. There is a difference. Maybe we should talk about that difference a little bit just to give just a touch on that knowledge of what it is a CPA does versus what you can do as a CFP and what the difference is between tax preparation versus tax planning.
Yeah, I think the biggest thing is that if you think of taxes as the road you're on, like you have to pay taxes. There's taxes ahead of you and there's taxes that are behind you. When you sit down with your tax preparer in the spring, what you do is you bring them a list of statements of things that happened last year, a list of everything you've done, and they try to fit it into the boxes the best they can and minimize the damage because you have to go back and pay that bill for what you already did. In that space, they're limited to what they can do. There are some creative things. There are some good ideas, but sometimes what's done is done. And they just say, here's what we got to deal with. We got to settle up this way.
Yeah.
And that's called tax preparation. And literally in my mind, it's just prepare to pay these taxes. That's it. And they prepare your tax return. Tax planning says, all right, I'm X years old. Over the balance of my life, how much am I estimated to pay in taxes? Is there any way I can lower that number? Can I make some intentional investment decisions? Can I make some intentional life decisions, business decisions that over the long haul will make a huge effect on how much I pay in taxes and how much is left for my kids or grandkids or whatever you want to build it for? But it's just a matter of saying over the course of my life, if I am on schedule to pay $2 million in taxes over the balance of my life, can we do a few small things to make it 1.5 million or 1.2 million? Can I do a few big things to get it under $1 million? That way, just more of my money stays in my family. So that, in my opinion, is tax planning. And that's what Ed Slott's referring to, whether it's Roth IRAs or life insurance or long-term capital gains versus short-term capital gains. or using a trust, or who owns the assets. There's a lot of different things we can do. Having an LLC or a C Corp and the difference there, like all these things matter in terms of how you keep money you earn. And that's the bottom line of it. How you keep money you earn and live the lifestyle you want to live. That's tax planning versus tax prep.
Okay.
We also need to make sure that we understand that taxes, while they are an obligation,
Mm-hmm.
we need to not see them as strictly a liability. They're also an opportunity. It's a
Well, that's a first.
yeah, and not an opportunity like you can choose whether or not to pay them. But
Yeah.
again, if we say, all right, we commit a lot of time often to what stocks do I pick, what bonds do I pick, what mutual funds do I pick? In my 401k, what can I choose? We spend 40 hours a year on average planning for vacations. That is the national number, 40 hours a year planning for your vacation.
Mm-hmm.
And so if we will put all that time into it, we should put some time into the thought of, hey, again, back to what I said, if I could make some decisions, could I lower my taxes in a good way? Or should I consider paying more in taxes this year and the next few years to avoid higher tax rates in the future? The Tax Cuts and Jobs Act is still in effect this year, 2025. And this is a year of tax reform. President Trump is going to have to do something about taxes. He's pushing some things through right now, seeing what lands. But eventually, by the end of this year, we're going to have a new tax plan for the years moving forward. And knowing what the taxes are this year, knowing what they will probably be the next 3 to 5 years, we should be making some decisions on whether we should get a lot more money taxed and into a Roth or into an after-tax vehicle. Should
Get
we
a lot more
be
money taxed, as in go ahead and pay the taxes
Yeah.
versus putting into a 401k where they're not taxed. Okay.
Yeah, and just choose when you pay taxes. You don't get to choose if, but you do have a certain amount of choice on when.
Okay.
Maybe we should be paying more this year. Not everybody, and I'm not making a recommendation. I'm saying you should have that conversation.
Yeah.
And if you go to your CPA or your tax preparer in March and say, I'd like to think about the next 25 years of my life and spend some time just pontificating and strategizing and looking at things, they're going to say, sounds good. Let's get together in September. Because they don't have time to deal with that in March. They are just...
If they say that at all, because a lot of CPAs, they'll be like, that's not what I do. And it's just not. It's just not what they do.
Yeah, and that's the difference in a tax planner and a strategic tax advocate versus a CPA or just a tax preparer. And again, I love my CPA. She does wonderful work. I'm a big fan of her in her office. And she is creative. That's why I work with her. She is a creative tax planner who knows the tax code better than I do. We know an awful lot. And unfortunately, we know more than quite a few enrolled agents and even some CPAs as it relates directly to personal finance. We have a lot of strategies and things that are in place that when we tell CPAs, they say that, I'm not sure if that's right. And they come back and say, oh, it is right. I say, I know, we do it all the time.
Yeah.
But again, we specialize in one space. CPAs have to know a ton of stuff about a lot of stuff. And so they know
they know a little bit about a lot.
Right. Yeah. And we know a lot about a little.
About a little. Yep.
And so that's kind of the space we're in. So understand that it can be an opportunity. And then also you need to understand that we need to figure in taxes into everything, into market returns. There's what's called an after tax return. Sometimes we look at the portfolio and say, hey, I made 10% last year, but it's in your IRA. So even though you made 10%, you get to keep about 7% because about 3 of it goes to the government when you take your distributions. We need to look at the tax effect on income. If I take money from my IRA, it now most likely triggers taxes on my Social Security benefits if I'm in retirement. And the amount depends, the amount that's taxed depends on the amount of provisional income you have. So there's these different equations that affect our income. Just because you earn more doesn't mean you make more. We've all gotten a raise at a job where you're so excited you get this raise, or you get a new job and they say, I want to make $10,000 more a year. Then you get your calculator out. You say 10,000 divided by 12 months. That's $833 a month.
Divided by twice a month.
And then I've got twice a month. So I get $416.50 extra per paycheck. And you're so stoked. You get your first paycheck and you're up $120. You go, what the heck is this? Well, the federal government got a raise. The state got a raise. FICA got a raise. How much you pay into all the insurances and everything else got a raise. Your 401k got a raise and you got what's left. So we need to factor that in. When we look at future expenses, we know that there's inflation on expenses, but there's an effect on taxes too. So if you're in retirement and right now you're pulling out $4,000 a month is what you need, $4,000 a month to show up in your accounts after tax.
Mhm.
Okay, well, to do that, I have to take out $5,000, withhold state and federal, and then I get the $4,000. It's a simple way to do it. It happens all the time. But then we say, well, I pay about $1,000 a month in taxes, $12,000 a year. But what happens if inflation keeps pushing up the price of what you need every month?
Mhm.
So then, as a result, you don't take out $1,000, you take out $1,200 or $1,300 or $1,400 for taxes because the inflation has driven up the price of what you need, which pushes you into new tax brackets.
Mhm.
So the effect on future expenses, on future medical, if you need long-term care and you're paying out of your retirement accounts, and inflation on medical is 9% or 7% versus the standard 2.5% to 3% on your regular lifestyle,
Yeah.
what it's going to take to pay after tax for your long-term care, and then how much you have to gross that up to get your taxes paid first. Taxes are a part of every little area of your retirement and of your life. And so to just take them as a one-time liability or something I don't want to deal with is not appropriate. We need to be tax planning, strategically tax advocating for our future, and looking at what we can do with them, not just being victim to them and letting them happen to us. So strategic planning, get ahead of it, be involved, and don't be afraid to have the conversation about when I should or shouldn't pay taxes.
It's more than just an annual conversation with your CPA. It's also more than a conversation about Roth, because I feel as though Roth has been this golden word that has just been floated around, but passed around almost to death at this point in the financial industry. Roth convert, Roth convert, Roth convert. It's not just so simple as take all your money out of your 401k and Roth it and then pay all the taxes. Don't go running and doing that. I guess that can work for some people. For some people, Roths don't work at all. Is that not true?
Well, and yeah, there's a point of diminishing returns, right? So I do love Roth, and I think we should get as much money into Roth as possible. But at some point in your
But when
life,
it comes to converting it,
right. Well, I'm saying, like, so I think as much as you can comfortably convert, you should. However,
yeah.
there's a point of diminishing returns where you say, well, now I'm just converting so my kids get more free money, and I don't want to do that. Or I push my Roth conversion up so high that now my Medicare premiums go up, and I didn't realize that. And so there's a secondary effect to Roth conversion. Also, before 2020, we used to be able to take that Roth IRA and stretch it over your kids' or grandkids' entire lives.
Yeah.
And it was a great way of creating multi-generational stretch money. And then when the Secure Act came out, they got rid of that stretch IRA and made it to a 10-pay system. So for a long time, we said, if you want to make multi-generational wealth, if you want to create legacy wealth, we'll convert money to Roth and name your kids and then your grandkids as tertiary or secondary to contingent beneficiaries. And we're able to stretch this money out over their life. It was a beautiful thing. And now your grandkids inherit money or your kids inherit money, and it's tax-free all of their lives, and such a low distribution rate that they should be fine through age 85. Then in 2019, the end of 2019, they put into effect the Secure Act that started January 1 of 2020. And that said, now when you inherited a Roth IRA, you got 10 years with that money. And it has to be out of the Roth within 10 years. So all of a sudden, that's not lifetime or multi-generational money anymore. So in terms of building a familial wealth and a long-term multi-generational wealth, Roth is a great tool, but it's no longer the end-all tool it used to be. I think you should definitely have it as part of the tool belt, but it cannot be the way of stretching monies 2 and 3 generations. So we have to be much more strategic about it than what it used to be.
Okay. Being strategic, that's part of tax planning process. And when it comes to your retirement planning, factoring taxes into things like your market returns and your income, but also medical and generational wealth, your estate and legacy plan. This is the planning that they do every single day at LifePlan Financial Design. So if you have questions about how you can be better planning for taxes, not just preparing annually, but planning for the many years ahead, let's get to work helping you figure out what your options are. Michigan's Retirement Coach is our website and where you can start the conversation with Mike and his team about your own retirement tax plan. We also have links posted in the show notes, so you can just click there. Or again, it's michigansretirementcoach.com.